deferring their capital gains taxes. Don't let your failure to plan become your plan to fail, especially when the Deferred Sales Trust may be one of the best ways to exit your highly appreciated assets. Defer the capital gains so that you can continue to grow your wealth. You are in the right place. I am not Brett Swarts. I am Jessica Lanning. I am filling in for him today, and I am an independent financial planner here in the San Francisco Bay Area. Each episode, we are joined by some of the leading wealth advisors, business and real estate experts, leadership specialists, and we share ideas and we tell our stories and we share our inspirations so that together we can make complex tax deferral strategies simple and passive income plans achievable. Our next guest is the founder of the world's #1 vacation rental investing education company. That's a mouthful. He's been investing in real estate for over 2 decades. He comes from the best investing school there is. If you ask me, it's the School of Hard Knocks. He's been there and he's done that. On his LinkedIn profile, he boasts that his work ethic got him a full-ride Division I basketball scholarship, which actually resulted in him bankrupting his first company.
Right.
I thought that was a great lead-in on LinkedIn. He is now obsessed with helping his clients build lifestyle and financial freedom, investing in vacation homes. Please welcome Shawn Moore to the podcast. Welcome,
Awesome.
Shawn.
Thank you, Jessica. What an introduction. Appreciate it.
Yeah, you're welcome. It's good to have you here. So let's have our listeners get to know you a little bit better. Tell me your story. How'd you get here? Talk to me about what your current focus is.
Yeah, awesome. So it's been a long road. We've been in the real estate investing game for 22 years now. I got into full-time real estate investing right out of college, and haven't looked back since. We've been around a lot of different asset classes, a lot of different ups and downs throughout those 22 years. And like you said, the School of Hard Knocks is definitely, it's an expensive school to go to and learn from, but hopefully now it's kind of led us to where we're at, and we're also able to share some of those lessons learned along the 22-year journey with our members here at Odyssey. We really focus now solely on short-term rental investing to create that lifestyle financial freedom with some passive income investments in that space. And but I've spent a lot of time originally when I got into real estate investing. I was doing a lot of the fix and flip stuff. We spent about 6 years. I fixed and flipped to 300 or 400 homes almost in that amount of time. So we were doing a lot of that. Started getting into the development game. And I remember back in my 20s, an old guy at one of the real estate investment club meetings, I would show up and I'd stick my chest out and boast how great of an investor I was and how big of a deal I thought I was back then. And this old boy named George came and put his arm around me and said, "Shawn, you gotta chill out a little bit. You gotta bring it down a notch. And you're not a real estate investor. You have a job fixing and flipping homes." And he said at that time, until you have assets that provide passive income, you're really not an investor. And at the time, it really hurt my feelings, right? George was really shot my ego. And so, but I started thinking about it. I thought, man, he's probably right. I'm hustling every day for that next home to find and fix and flip. And then I have to do it again and again and again. And, so at that time, we started kind of opening our eyes to what I think is the holy grail of real estate investing is buying assets to provide passive income. And so we started looking at assets that were longer term assets that we could pull passive income from. We started building a portfolio of short-term rentals. And so that was when I started finally getting into some passive income investments and build a portfolio of about 52 homes, mostly single family, couple duplexes along the way in there. And that was early 2000s when you could fog a mirror and get a loan. And so we were able to grow our portfolio pretty quickly, and it'd be a little more difficult to do, I think, that now with lending standards nowadays, but we were able to grow that pretty quickly, and ended up in 2005, started saying, I don't really know if I like this. I don't really know if this is my cup of tea. I had a bunch of properties that were bringing me in about $3,000, $3,500 a month in passive income. And, our average fix and flip deal was we'd bring in $35,000 to $50,000 on each of those deals. I'm like, this is, it just seems better. So I'm going to sell all these properties. I'm going to go back and start doing development deals, bigger deals. And really at the time, and then the market started going down in 2007 and 2008, I thought I was a genius, right? We made a lot of money on our properties. We sold them at a pretty high end in 2005. But really, that was probably, Jessica, the biggest mistake I've ever made in my real estate investing career, because we got rid of a bunch of assets that were creating passive income. Somebody else was paying for them. They were appreciating. Everything was working really well. And we were able to depreciate them for tax purposes and all those different things. And I got rid of them, and I didn't upgrade my portfolio into something else that created passive income. There's nothing wrong with selling an asset, but at the time I just cashed out and I used the money for some stuff and I paid off things, but I didn't reinvest it. And I look back now, and it took me about another 8 to 10 years before we really started diving into and building our portfolio of passive investments again. And in about 2013, 14, 15, we started building a portfolio of short-term rentals. But that time lost is huge when you're a real estate investor, right? And so that was a big mistake that I had George that kind of opened my eyes to passive investments, and then I got rid of them and didn't restart again. And along the way, we started getting introduced and having a lot of fun with short-term rentals, and that's what we do now. That's where we're at right now with that.
So just for our listeners, define short-term rentals for us so we're all thinking about the same thing.
Yeah, most people will define a short-term rental as an Airbnb or a VRBO. They'll think of Airbnb properties, vacation homes are typical, but they don't always have to be vacation homes. Typically, a lot of people will think of short-term rentals as home vacation homes. And a lot of our portfolio are vacation homes, second home type areas. And but what a short-term rental is anything that leases, really the definition is anything that's a less than 30-day lease length. Most of the time we think of nightly rentals, and that's what we prefer in our portfolio. But a lot of times we'll have properties that have 7-day minimums, 2-week minimums. But really, a short-term rental is a nightly type rental that you would normally think about seeing on Airbnb or VRBO.
Got it. Okay. Let's just talk about you just a little bit more, and then we'll get into the business of all this. We believe here at the Capital Gains Tax Solutions that everybody comes on the planet with gifts, intrinsic gifts, right? That make us successful. What are yours? What's your superpower?
Yeah, wow. I think some of it is perseverance, right? We're able to just kind of keep battling through some of those hard times. I would say that anybody that has any sort of success, that's probably one of the superpowers that most of them have right at the top of the list. The other thing that I think that we do here and that I've been fortunate to be able to do is I kind of look at things through a different lens, right? I love business. I love different types of marketing. I'm a big marketer. And so I'm able to look at real estate through a little bit different lens. And we're able to, which is what kind of led us to the short-term rental game. We're able to treat this like its own asset class. Short-term rentals a lot of times are still just single-family homes that people are putting on Airbnb. We actually are able to look at it and say, okay, we're going to identify this as its own individual asset class. In real estate, every asset class, whether it's apartment buildings, commercial properties, single-family rentals, short-term rentals, they all have their pros and cons. And I think that one of the things that has helped me along the way over the years, outside of just being able to, when we get knocked down, get back up and try to figure it out, is to be able to say, okay, everything is a little bit different. All the real estate's a huge ocean, and it's not and shouldn't all be treated the same way.
Got it. Yeah, I heard a lot of resiliency in your story.
Yeah, there's
resiliency.
Yeah. Anybody that's been around has got as many gray hairs in their beard as I do. That they've got to have some of that, right?
That's what I say. Like, I've earned every single one of these wrinkles.
Right, exactly. That's why I love it. Yeah, those are all earned, right?
All of them are earned.
Yeah, love it.
So we're talking today about building wealth with short-term rentals and unique tax strategies that are available with short-term rentals. So you've talked a little bit about what you do and how you do it. Talk to us a little bit about the tax piece of this. So how are you talking to people about taxes?
Yeah. And obviously I'm not a CPA and not here to give tax advice, right? But we are
absolutely not.
Yeah, we've been around this, and this is short-term rentals are a very unique asset in the sense that a lot of times people, when they're investing in real estate, they've got a lot of great tax advantages if they're categorized as a real estate professional. A real estate professional is a hard designation to get if you are not full-time in real estate, and that's your full-time job, right? Because of the requirements to become a real estate professional. So some of and what that really means is we're able to write off the losses on our investments against our passive losses, not our active income losses. So for example, if I have a $10,000 loss on a property and I'm not a real estate professional, I'm able to write that loss against all of my passive investments, but I can't take it against my W-2 income, for example, or my earned income, right? And so With short-term rentals, there's a loophole that if you have properties that have a lease length of less than 7 days average, which most short-term rentals will qualify for that, they become an active trader business. And so in an active trader business, we can, as an investor, we can materially participate in that business. And there are some requirements for that, but we can spend X amount of time materially participating in that business. And now all of a sudden, we can qualify all of those losses and all of that depreciation, which is the big thing, with bonus depreciation against our active income. And so we have a lot of investors who will come to this game once they learn that and say, hey, I've got this big tax bill. I want to buy one of these assets. And ultimately, Uncle Sam ends up paying, a good portion of their down payment. And so it's a really exciting asset class once you understand kind of that loophole to where they become these active trader businesses and treated as such, as long as we materially participate. I'll give you an example of the power of it. Is a property that we just bought. Is about $800,000 acquisition. We put $200,000 down on the property. And so that $200,000 went to our down payment. What we ended up doing is we materially participated in the property. There's a whole bunch of requirements to materially participate. You want to talk to a CPA about it, but kind of the safe harbor is you're going to spend 500 hours on the property, or you're going to spend at least 100 hours on that property and more than anybody else. So, but we're able to do that. And during the first year of acquisition on a short-term rental, particularly, that's pretty easy to add up those hours because you got a lot of time analyzing, you got a lot of time setting them up, you got a lot of time launching. And so if you're very diligent about tracking them, I don't want people to think, hey, I can just go buy a short-term rental and all of a sudden I qualify. There are qualifications, double check that. But on this example, $800,000 acquisition, we put $200,000 down. We're going to cost segregate the property. We're going to get a cost segregation specialist that will cost segregate that property. And we're going to have an active, and then we're going to bonus depreciate it. And we're going to have a loss of about $360,000, $370,000. Usually you're going to get somewhere around 30 to 35% of the value of the property that you're going to be able to bonus depreciate. And right now in 2022, we get 100% bonus depreciation. So I'm able to take that $370,000 loss against my active income, which is going to reduce my tax liability by about $165,000. So my net into this new property is going to be about $35,000 because I just reduced what I'm ultimately would be paying in taxes by $165,000. So it's a really powerful tool. It works well if you are going to be, if you actually have income. It doesn't work. You're not going to get any sort of a refund or anything like that. But if you have income and you're paying a big tax bill, these types of assets can be a huge way to be able to minimize that. Now, if I ever sell my property, to your point on capital gains, I have to recapture any of that depreciation, right? So we will end up always making sure that we'll look for other investments if we resell that we're going to put that back into through 1031 exchanges, things like that.
Got it. And is it worthwhile for our listeners here? And let's just go ahead and do this. When you accelerate depreciation like that, why don't you talk about why you would do that versus the regular depreciation schedule? Because I think that's a valuable point. Yeah,
well, and I think that you don't always have to do it, right? You want to talk to your financial advisors, your tax advisors, everybody that's on your team to helping you make those decisions. I own many properties that I don't do this with and there are certain reasons why you would and you wouldn't. I believe the time value of money today. If I want the money in my pocket today, a lot of people believe that, and they can do some more things with that money than not. But if I'm going to resell that property, and I know that I may not be putting it into another investment, and I'm not able to do a 1031 exchange, if my general rule is if my exit strategy is less than 5 years on that property, I probably won't do a bonus depreciation. I probably would just let it depreciate, and so I don't have this big recapture at the end on the sale of the property, right? And so there are reasons that you may do it, and there's other reasons you may not do it, right? And, this year we still get 100% bonus depreciation. Next year that's going down unless anything changes, but they've got it to where it's going to go down to you can only capture 80%, and then it's going to go down another 20%. So these are strategies and things that you want to talk to your advisors about, and because there are pros and cons to doing all of it.
So you're running this company now that's teaching other people how to do this. I'm curious, what are you telling them? Like, what's investing 101 for short-term rentals?
Yeah, one, we want to make sure this is the right asset class for somebody to invest in, right? pros and cons of short-term rentals. They're a lot of fun to own. It's fun to have a portfolio of, properties in beach areas, mountain areas, areas that you would love to own a vacation home. I always tell people. So it's a really fun asset class to own. There is a little bit more time involved in this type of an asset than maybe buying an apartment complex or anything else, because you've got people that are moving in and moving out all the time. Now, we do hire full service property managers to deal with that, so we're not always dealing with that. But even on the front end, your acquisition is going to take you a little bit more time, especially the setup. You're furnishing all these properties, you're getting them all set up before somebody comes in. Those are tough things to outsource. And so until the property is handed over to the property manager, there's more time involved. And so we want to make sure it's the right asset class for somebody. But after that, we want to make sure that they walk into the game with their eyes wide open as well. I always tell people there's good properties and bad properties in almost every area. You really have to understand how to underwrite this type of an asset, because you could go into a great beach town. Let's say you go to, Destin, Florida, and you're like, hey, everybody's here has great homes and it's somewhere that everybody's going. Not all properties in Destin, Florida perform very well. And so some perform awesome, some don't. And there's some areas that don't. And so it's really understanding when we have somebody dive into this game and say, hey, let's get you walking into it with your eyes wide open from all aspects. Make sure, one, that this asset class fits your property goals and your lifestyle that you're trying to create. Two, sometimes we're talking about the tax. We'll have somebody that will call us and say, hey, I heard this tax strategy. We've had some RCPs on our podcast, and they call us up and say, I want to buy one of these just for the tax strategy. And we say, that's not the reason. We don't want to let the tax tail wag our investment dog, right? I mean,
Right.
We don't want to make decisions just based on one thing like that. And so when somebody's interested in investing in, and I guess, some of those 22 years of learning and experience, you start to ask a little more questions and make sure that that this is the right fit for somebody.
Because I think there's a big difference between owning your own home and then buying investment real estate.
Huge.
When you're buying your own home, you're nesting. When you're buying investment real estate, it's about doors and windows.
Yeah.
And I'm often telling people think, well, I'll just go buy a place in this place that I love. Well, not everybody's going to love that place, and you might not get the return that you want.
Right.
So there is a real shift in mindset that has to happen around that, or they don't go in as a business owner. They go in as, I'm going to go find a second home and rent it out.
Right. Exactly. Very, very different. And that's where understanding the asset that you're diving into. Like, I love real estate. I've always been in real estate. It's what I understand. It's what I love. I think it's a great tool for average everyday people to build wealth. I think I feel like that there's, but sometimes, especially when we're talking about single family rentals, and I see it mostly like on single family rentals, or now the short-term rentals are becoming so mainstream that they think, well, it's just a single family home. I understand that, because I've already bought and sold 3 or 4 homes that I've lived in. That's totally different. You've got to treat it as its own investment tool.
Absolutely. I'm a financial planner. And so, I love real estate as part of an overall financial plan. It's just a phenomenal asset, but it is a high maintenance asset, and you really got to love it. But my clients who love it, boy, I show them, I can show them a statement with as many commas as you want of stocks and bonds, and their eyes glaze over. But boy, you show them $100,000 house, they're like, but I like it. That.
Yeah. That would be me. Like, that's how I was like I have such a hard time with some of the other things. And one of my best friends, he's my financial planner, and every time, so I diversify our portfolio. We buy, stocks, and we have different things that we do. But I just have him do that for me, because I have no interest. It's like, but you show me properties, I'm like, I can look at that all day. So I guess I'm a unique breed, but I think I totally understand what you're talking about with some of your clients there.
Yeah. So talk to me about the 1031 exchange. Is that a tool that you're using often?
Absolutely. Yeah. It's, we use 1031 exchanges a lot when we upgrade portfolios, sell properties, and put back into another investment class. I don't see any reason why somebody wouldn't think about that. If they are going to be putting the money back in, you might as well defer that tax as long as you can. One of the facilitators we talk to, she always tells people, to die with this big tax bill that you just kept deferring with all these properties. So she talks about how to just continue to do that. And so you don't end up paying that capital gains. Now, again, you have to make sure you're doing it correctly and that you're doing it the right way, and making sure that your property and financial goals, that is what you want to do. Maybe you say, hey, that I'm done with it. I'm done with real estate, or I want to put it somewhere else. You're gonna have to probably come up with that capital gains, right? You're going to have to do that. So that's why an overall financial plan and an overall strategy is so important for people when they think long-term, because that 1031 exchange tool is a huge tool for us as investors to continue to be able to roll that capital gains into that next property and continue to parlay that up.
So what's your biggest frustration with the 1031?
The time frame. It's more often than not, especially in the markets as they are right now, that 45-day identification period is as low as inventory has been the last few years. That's a tough. I mean, sometimes your back's against the wall there.
Yeah, it's brutal. I share that frustration with you. Here at the Capital Gains Tax Solution, what we do is show people how to not do the 1031 exchange and explore another opportunity called the Deferred Sales Trust in order to continue to defer those capital gains, but not have to go back into another property. I think when people are done with their real estate, right, they're kind of done doing the fix and flip, or they're done doing the short-term rentals, or they're done managing that apartment building, right? They're tired of the toilets and the tenants and the trash, and they're just done. The Deferred Sales Trust is just such a great way to get out of really highly appreciated assets.
Yes, absolutely. And I don't have, full disclosure, I don't have a ton of experience with the Deferred Sales Trust. I've heard some of our community members talking about it recently, and so definitely trying to learn a little bit more about that, because we've always just used the 1031 because we continue to stay in the asset, and so we're going from one to the other. But I'll tell you what, that time frame, that identification period, and all that makes it very difficult. You have to really plan out a 1031 exchange, especially now. Like, it's almost easier to identify the property you're going to be buying way before you try to sell, and so and that doesn't always work out either. So it's tough to pull off in certain cases.
Yeah. And, we've rescued 1031 exchange failures,
I bet you have.
The 11th hour, we're like, we'll take care of it. Right. And we get it done. You're always welcome, and our listeners are too, to go to the capitalgainstaxsolutions.com website. You can also learn more about it on my website, which is lanningfinancial.com. And that will help you learn more about what the Deferred Sales Trust is all about. And let's, while I'm doing that, would you please let our listeners know where they can get a hold of you?
Yeah, absolutely. The easiest place is just go to our main website, is vodyssey.com. It's VODYSSEY. And if you go there, we've got a lot of really good free trainings. We've got a best-selling book on Amazon. You can go buy it on Amazon if you'd love to. But if you don't want to pay for it, you can download a PDF copy on our website. It's called What the Hell is a Lifestyle Asset? And it talks about the pros and cons of short-term rental investing and kind of our view of this world and step-by-step process. So lots of good information, resources that they can check out. Just go into vodyssey.com.
Excellent. All right. Are you ready for the lightning round questions?
Love lightning rounds. So let's do it.
All right. Your favorite book, or the book that you have gifted to people the most in the past year?
Winning by Tim Glover.
Very nice. What'd you like about it?
I love Tim's take on the premise of the book is winning is hard. Winning is ugly and hard, and it's grueling. And I just like the message of what it takes to persevere to really win at anything.
Nice. Okay. Your favorite leadership quote or theme you strive to live by?
My favorite quote is, I say it all the time, is go build the life that you don't want to take a vacation from. And so I love that. I say that. I don't, and so that's kind of a quote from me, but I say it every day of my life. Like, let's go build the life that we don't want to take a vacation from.
And so if you could imagine yourself, if you could go back in time and visit your 25-year-old self, what would you tell that person?
To 25 years old, I tell him to calm down and quit thinking that he's arrived. Right? It's I needed a dose of humble pie when I was back at that age, and so until I got knocked down a few times, I started to realize that I wasn't quite as cool as I thought I was.
Fair enough. What are you most curious about right now?
I'm really, for me, I'm really curious about what I've got young kids. And so this is completely unrelated to, what we're talking about with taxes and everything else. But for me, what really drives me in curiosity is what can we do for that younger generation to really start to change their outlook on life? I feel like that we've gotten into this stage where we really focus on the negative. And I'm so curious on how we're going to change the narrative to start focusing on the positive again.
Yeah, amen. All right, you've had so much success in your career. What is one habit that you do every day or every week which helps you stay centered in your values and keeps you moving forward to your next goal?
Yeah, I have a very, very specific morning routine. And if I miss it, it is, it has to do with some gratitude things that we do, that we go through. It has to do with some workouts that I do. Every single day I wake up and do the exact same thing, but it's stacked around, gratitude, family. I spend some time with my wife every day, having coffee. I do a workout before I ever get my day started. So we wake up pretty early to get a lot of that done. And that has helped me. I review my goals and what we're trying to work toward every morning and every night. And so those things have really helped me. I started doing that about 10 years ago, pretty religiously. And I've for me, that's helped me more than anything. And I don't know that I feel like if I don't do that, things are going to unravel. So we stick to that.
Morning routines, everybody's doing them. So
right.
Yep, I hear you.
Yeah.
Well, listen, thank you so much for being on the show. I want to encourage you to keep using your gifts of resiliency and looking at things through a different lens. That's where the creativity is. That's where to harken back to blue oceans, right? That's where the blue oceans are,
Absolutely.
So let's tell the listeners again, for those of us who want to get in touch with you, what's the best place to go?
Yeah, go check out Vodyssey.com. You can get our podcast, book, trainings, everything you want there. VODYSSEY.
Excuse me. So that wraps up the show. I want to thank you, the listener who are here today, for listening to another episode of the Capital Gains Tax Solutions podcast. Again, this is where we believe that high net worth individuals and their professional teams should not have to struggle to find options, really great options for deferring capital gains taxes. Please don't let your failure to plan become your plan to fail, especially when the Deferred Sales Trust may be one of the best ways for you to exit your highly appreciated assets, defer that capital gains tax, and continue to build your wealth. Please remember to rate, review, and subscribe to the podcast. And thank you again for being here.